Welcome to the InterMarket Analysis video update. This is a weekly video where we look at a number of different things outside of the S&P. We also look at some things inside the S&P to try to get some clues as to what's actually happening inside the S&P itself. We look at growth versus value and see how those areas are looking. We look at valuations of the S&P, and then we look at the different sectors that make up the S&P 500, and then we look at other indexes and other markets. And I put all of that together into this video that I call the InterMarket Analysis video. This is being prepared for Monday, October 28th. Before I get into the video, I want to tell you about a program that I've developed. It's up, it's going, it's free until the end of 2024. It's called the SPXInvesting Program. If you want to go and check out the website or check out a video that talks more about the program, there are links below this video. If you have any questions, you're more than welcome to send me an email. Also, this is just one of the weekly videos that I do. It's the InterMarket Analysis video. I just got finished doing the weekly video, and then later on I'll do the what to watch and deep dive video. But the daily video is really the foundation of the analysis that I do. And we can see things happening that may be starting to develop, and then we can watch for those things to see if they continue to develop. So if you're more interested in a day-by-day analysis of what's happening in the market, please feel free to check out the daily videos. Let's go back and talk about S&P 500 valuation. Now, the first area that we look at is we look historically. We look back, and this is called the TTM, or trailing 12 months. And what you see here are a series of dashed lines: red dash line, blue dash line, green dash line. And these are doing a ratio between the current price of the S&P and the historical earnings that have been released. And there are static numbers. When we're at 10 or below, the market is considered to be inexpensive or cheap. Between 11, my goodness, between 11 and 19, that's where the market is considered to be more fairly priced. And then 20 or above, the market is expensive or overvalued at that point. And based on where the S&P is at right now, it's well above the red dashed line. To break it out a little further, this measures the distance from the S&P to the PE ratio of 20. So on a historical basis, we are considered to be overvalued. Now, I don't use this to make decisions. We just want to know this because this can last for years at a time. Also, to give it a little bit more context, here are different events that have happened and what the valuations were at that particular time. Another take on this is called the Shiller PE ratio, or CAPE, C-A-P-E. You might also hear it referred to as PE10. It takes earnings and smooths them out over a 10-year period of time and then compares that with the current price of the S&P. Right now, this is coming in with a reading of 36.99. And to give it a little more context, here is a historical chart. Then we also look at the median and the mean, where we're between 16 and 17. So with the current reading at 36.99, yes, this is also confirming, looking back historically, the S&P is considered to be overvalued, but it's been overvalued for many years now. The market looks forward, and these are forward PE ratios, and this is what really impacts the market more directly. Have a number of different PE ratios on this chart. We have the mega cap 8 in purple, where they're coming in at 29 right now, very high. They're very expensive right now because we still use that 10, 15, 20 scale. Even the S&P is still coming in over 20 at 21.5. More fairly priced right now are the mid caps and the small caps. Now, the mid caps are coming off of setting a recent all-time high. The small caps, they're lagging a little bit. They go to the high end of a range and then they fall back, and then they go back up at some point and then they fall back. But the mid caps have actually been one of the stronger indexes at times throughout 2024. Then this is something that I found from Isabel Net. This looks at just the 10 largest stocks and what their PE ratio is, and that's coming in over 30 according to this chart. And then you take the S&P 500 without these 10 stocks included, and you have a much more reasonable but still kind of high PE ratio of 19. here. We're under that 20 level. It's the big companies that are pushing the PE ratio up. Then also, and I harp on this over and over and over, it's ultimately earnings that drive stocks. There can be events that happen and things come out and stocks go up and stocks go down. But looking at a long-term chart here going well back into 1999, you can see the red line here. This is the trailing 12 months here. I'm sorry, this is the forward looking PE ratio, and then what the S&P does. And when this is going up, the S&P is going up. When this is going down, the S&P is going down. Now, this is very long term, and it can take a while for this to come into line with things because we're looking at such a long-term time frame here. But we tick down a little bit, but for the most part, the red line has still been continuing to go up. Then we look at growth versus value. Growth is what we want to outperform value when the market's really going up. Now, there are times when value does quite well, and it's been doing well, and the market's still been hanging in there. But when we get the really big moves to the upside, we want to see growth outperforming value. So I have a number of different charts that we look at to compare the two. First of all, we just look at growth by itself, and it's really doing well and in a solid uptrend. We look at value all by itself. It's also in an uptrend. Then we look at ratios, and this is a growth to value ratio, so showing how growth is outperforming value. Here's an inverse of that same chart showing how value is underperforming growth. Then we look at a longer term chart here, growth to value, showing how growth is outperforming, and inverse showing how value is underperforming growth with these indexes. We look at some ETFs. Growth is also outperforming value. And here's another look showing how, with a shorter term chart, how value is underperforming growth. So we're getting a lot of confirmation here. Then another measure just shows the indexes, how growth is outperforming value. So that's more positive for the market. Then we look at a growth ETF and do a ratio with a value ETF. And this had been really languishing here. We were down near the end part or the lower part of the rainbow, which is a 250-day moving average here in black at the bottom. Well, we've been seeing this coming out, and if the market is going to be turning more positive in the upcoming week or two, we want this ratio to really go up, and it's showing some improvement right now. And we break it down and look at mid caps here, where we're in a downtrend. When we look at mid cap growth to value, small cap growth to value, really lagging behind. Then we look at value to growth here, just an inverse of the previous chart, showing how value is underperforming growth. And then this is a little more encouraging at this time. This has also been very frustrating at various times, where this is after Friday, and this is a daily chart of a growth to value ratio, and we're in an uptrend here, and we've really been showing some improvement. And this could end up being positive for the market, at least in the short term. We keep an eye on inflation. We have a monthly chart of the CRB index up here where we're pretty much going sideways. And then we look at a ratio between inflation and deflation down below. When this is going down, that means that inflation is going down as well. And that's what the market likes right now. We look at the CRB index. This is a daily chart where it came down and actually had a death cross here and then started to shoot up. And the moving averages are improving, but now we're coming back down to the 50-day moving average. We'll see if that goes up. Now, typically, as a general rule, when this is going up, that could be inflationary, and stocks don't really like that. But there are times when they both move together. We keep an eye on the Baltic Dry Index, which actually we're seeing a drop off here. We've been pretty much chopping sideways. This is used to measure in a general sense that when it's going up, that means it costs more to ship products in the Baltics. When it's going down, that means it costs less. But we really have been going up and down and chopping all over the place in 2024. Then we keep an eye on some other markets just to see what's going on there, where aluminum is now going up and starting an uptrend. Corn is in a downtrend. Wheat is also in an overall downtrend. Fertilizer has been going up lately, but not really shooting higher the way it was a few years ago. We're keeping an eye on oil, mainly for geopolitical reasons. It came down under 70 and then climbed back above 70. We're still hanging out between 71 and 72 right now. Then we look at a ratio between gold and oil. Gold has been outperforming as oil has been not really going up, because you would think if things really escalate in the Middle East that oil would be going up. But Gold continues to outperform oil. We also look at oil and do a correlation with the 10-year yield. And you can see over time where these tend to move more or less in tandem with each other. Right now, though, they're pretty much neutral, where they're tending to go in the same direction and it's getting stronger. But when we're in this plus 25 to minus 25 area, that's what I consider to be neutral. Gas is in a political election year downtrend right now. Heating oil is also in a downtrend. Natural gas, it's kind of chopping around. It's a little bit in an uptrend right now. And then we look at diesel here, which had been coming down overall. It was going back up. Now it's starting to come back down. And that's what does it cost for railroads and 18 wheelers mainly. If it's going up, it costs them more, and that's inflationary. Copper, which is a general barometer of the economy, still in an uptrend. So economically, we're looking okay. We look at a copper to gold ratio, showing how copper's been underperforming gold. Even though gold is in an uptrend, copper's in an uptrend, gold has been going up stronger. And this is a longer term chart of that same ratio. And I also plot the 2-year yield and the 10-year yield on here. And we're seeing a really wide spread. And I have an additional chart right after this. This shows that same thing. Purple, that's the copper to gold ratio and the 10-year treasury yield, where you can go back and see where they tend to move in the same direction and not get too far apart. We've seen a real wide disconnect right now. Is this what's going to happen to change this? Are interest rates going to go back up? Excuse me, are interest rates going to come down? That's the black line. Or is the copper to gold ratio going to go up? Now, typically, when the economy's doing well, copper outperforms gold. And we would see this ratio going up. But with gold breaking out, and there's a lot of uncertainty going on right now, that's why we're seeing gold outperforming copper at this time. And that's why that tends to be more of a fear of inflation at some point. So we're just keeping an eye on this. We've been watching it for a long time now to see if we get any insight other than there's a really wide spread here and something will probably happen at some point to get these lines back closer to each other. Gold is coming off just setting a recent all-time high with the ETF. Silver is also in an uptrend, even though it's been pulling back lately. We look at the closing price of gold and the closing price of silver, and they're still having a pretty strong correlated relationship with each other, which only makes sense. And then we look at a gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we look at the US dollar index. We try to get some insight between these two charts. But right now, they're kind of going in the opposite directions and just coming out of being neutral, more or less. So we're not really getting any insight from this chart. The dollar is in a downtrend as measured by moving averages, but really going up solid. We're back up into the 104 range. And we're breaking out here above this downward sloping trend line as the dollar's been really recovering over the last month or so. We look at the euro, which is going down compared to the dollar, where the US dollar index is going up. And then we look at the Japanese yen as well, the euro and then the US dollar all on the same charts. Then I break them out. And even though the euro's really been pulling back against the dollar, it's still in an uptrend overall. The blue line's above the red line. And the Japanese yen, which had been in a really solid downtrend against the dollar, really shot back up. This was July and into August when all those crazy things were happening in Japan. Well, since that time, it's really been pulling back, but the yen is still in an uptrend compared to the dollar, measured by the moving averages. And the British pound pulling back against the dollar, but still in a longer term uptrend. We look at different indexes. And I typically show this in the daily videos where we're not seeing much of a disconnect between the weighted version, which is the regular S&P 500, and the equal weighted version. We did see a little bit of a downtick here. In Friday's session, the big stocks, which control more of the S&P weighted version, they held up better, where the other stocks that make up the S&P 500 didn't perform quite as well. So that's why we're seeing the red line dropping down a little bit here. And then we look at a ratio between the equal weight and the S&P 500 weighted version. When this is going down, the equal weight is underperforming. We're pretty much chopping around, but seeing a little bit of weakness now. What we're watching and what seemed to be helping the market on Friday was the mega caps, the semiconductors, and growth stocks had a really good day, where value, which had been stronger lately, it saw a lot of weakness on Friday. We want to see if that's going to continue. And if it does continue, that could be more positive for the S&P. If it's just a 1 or 2 day thing that kind of comes and goes, then it's not really going to tell us all that much. We look at a ratio between stocks and commodities where stocks are still outperforming. Here's an inverse showing how commodities are underperforming stocks, and that's been going on for quite a while. We look at the NASDAQ 100, which is actually underperforming the S&P 500. Now, the NASDAQ 100, it hit its high back in the middle of July, July 16th. Since that time, it's been holding up. It's not falling apart, but the rest of the S&P started to outperform enough to see a death cross with this ratio. When we were really going up solid, that's when the NASDAQ 100 was outperforming the S&P. But the S&P 100, which are the biggest stocks that make up the S&P 500, those are continuing to do quite well. We look at another ratio between the NASDAQ, which is in a downtrend compared to the S&P, because the NASDAQ is more tech. The S&P has the mega caps in it, but it also has more value in there, and it's been holding up a little bit better. And that's why we're seeing a death cross here recently with this ratio. But over the last couple of trading sessions, we're seeing a real improvement here. We'll keep watching this. The NASDAQ 100 is underperforming the NASDAQ, which is not what we were seeing in 2023, which really led the market higher. Now, it doesn't mean the market's falling apart. It just means the market is shifting. Instead of just a few stocks really driving things higher, which is what it was doing up until the summertime in 2024, now we're seeing a lot of the NASDAQ stocks start to perform better. So both are doing well all by themselves. Then we look at the mega caps to the equal weight version of the S&P, where we were going sideways for a while, but now we could be seeing some signs of improvement here. And that would help the index go higher if this ratio continues to go up. Small caps continue to underperform the S&P. We also look at this red line, which is a small cap to S&P ratio. That's continuing to go down as the blue line, which is the S&P, continues to go up for the most part. And we look at another ratio between the small caps and the tech sector. When this is going down, that means tech is outperforming. Small caps are underperforming. We're chopping around a little bit right now. We'll have to see, are we going to break to the upside with this ratio or break to the downside with this ratio? Things are a little bit muddy right now. We look at the big software companies. They're in a pretty good uptrend. Mega cap, when you look at them all by themselves, they pulled back a little. Actually, they were up a little bit. They had been pulling back a little bit, but they're still in a really solid uptrend, and that's really what's driving the market. The robotics and AI ETF coming up to the top end of the rainbow, looking good when you look at it all by itself, but still underperforming when you do a ratio with the tech sector. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities, is still looking pretty solid. A week ago, the Dow set an all-time high. The utilities had been pretty strong. Transports are just going sideways, but we saw some weakness in the Dow this week. Utilities saw some profit taking, and that's why we're seeing this going down. But overall, the Dow Jones Composite Average is in a pretty solid uptrend. The Wilshire, another broad market measure, coming off of a recent all-time high, still in an uptrend. And then the total U.S. stock ETF, also a little bit of weakness lately, but still looking pretty solid there. Low volatility stocks, when you look at them all by themselves, they are in a solid uptrend. And this is what folks get into when they're more defensive. But we've been seeing a really solid uptrend for all of 2024 as the S&P has been setting all-time highs. Where we get some insight is when we do a ratio. We look at the low volatility versus the SPY, and they're really back to underperforming. Now, they were going down, and that means the low volatility stocks were continuing to underperform. And then we hit the summer months, and things gyrated a little bit, enough to generate a golden cross with this ratio. But not too long after this was generated, we've been seeing some weakness with this ratio. If this continues to go down, we would see a death cross with this ratio, which would end up being positive for the S&P. We look at the advanced decline line studies, which I do show in the daily videos, seeing a little bit of weakness, but still above the moving averages with the NYSE common stock, the S&P 500, the mid caps, but the small caps are starting to fall slightly below the moving average. The one positive thing here with all of these is that the moving average is going higher. We look at traditional Dow theory, the Dow coming off of a recent all-time high. Then the transports just kind of floundering for most of 2024. The utilities had been strong, but saw some recent weakness. We look at the transports, which this also just shows how they pretty much have been going sideways. We look at a ratio between the transports and the S&P. When this is going down, that means the transports are continuing to underperform the S&P. And then we look at another ratio between the Dow and the transports. When this is going up, which is pretty much what it's doing, that means the Dow is outperforming the transports. And we look at a correlation between the S&P on top and the transports. This is just showing that there's still a pretty strong relationship between the two. We're still up in this red area. But the transports have just been chopping sideways. They're not falling apart, but they're not really breaking out either. Then we take a new slant on Dow theory, where instead of using the Dow, we use the S&P 500, coming off of a recent all-time high, but down this past week. And instead of using the transports, we use the NASDAQ, not quite back to an all-time high yet, but still holding up. And the NASDAQ actually held up better this week than the S&P 500. And then we break that down a little further, looking at the equal weight S&P, a little bit of weakness this week, and an equal weight version of the QQQs, which is the NASDAQ 100, also showing some weakness here. It would be nice if they were both setting new all-time highs right close to each other, and that's what they were doing recently. If these both turn back up, naturally that would be more positive. The FANG index still has a ways to go to get back to the high set last summer, but still looking pretty solid. And then we've been tracking a shorter term trend line here. We're still below that, but we're still above the longer term trend line with the FANG index. And ARC just continues to be in a downtrend, and at best is just chopping sideways. We use the all world ETF here, which takes out US stocks, pulling back a bit here, but still looking pretty solid by themselves. When you compare it to the S&P, US stocks are continuing to outperform quite a bit. Then here is a monthly chart of the S&P with a ratio of this EFA. These are stocks in Europe, Australia, Asia, and the Far East, showing how US stocks are continuing to outperform. And again, this is a monthly chart. So longer term, we're seeing this momentum oscillator continue to go up. We look at bonds versus stocks, which they had been doing better, and then interest rates were going up as this is going down. And here we look more just at bonds based on price. They're still in an uptrend, but they fell underneath their 50-day moving average. The world index also in an uptrend, but falling down to their 200-day moving average. But when we look at a long-term chart of stocks versus bonds, stocks really are outperforming bonds and have been for, well, going back to after the COVID crash. This is a daily chart showing again how bonds are underperforming stocks. We look at high yield corporate bonds, which are junk bonds. Yeah, they've seen some weakness here, but they're still above their 50-day moving average. Corporate bonds also fell underneath their 50-day moving average. These are more conservative bonds. They're called investment grade bonds. And we look at the Dow Jones Corporate Bond Index, which is seeing some weakness, but still in a longer term uptrend. And then we look at a daily chart of the yields where they were really coming down and that was helping stocks. Well, now interest rates have been going back up. And it's getting to the point where the market is starting to notice that. They ignored it for a while. But if interest rates start to go up, or continue to go up, that could really put some pressure on stocks. A weekly chart looking internationally, where we have international rates going up in the US, UK, Germany, as well as Japan. Then we look at the 10-year yield, but we're not close to any of these fib retracement lines. This is a long-term chart going back to 1980, where we're shifting up into a higher range now for the 10-year yield. 30-year yield with some fib retracement levels, not close to any of the lines right now. Then we look at some ratios between the S&P 500 and short-term bonds based on price, showing how stocks are outperforming. We're up above the rainbow. Then we look at a broad market measure with short-term bonds, coming down but still above the rainbow. And we look at a broad market measure and go a little further out with the price of bonds, showing how stocks are outperforming. We look at the tech sector, which is hanging in there pretty well when we compare it to 3 to 7 year bonds. Then we do a ratio between riskier bonds like junk bonds and more conservative bonds like government bonds. And we really saw this ratio coming down, but now it's starting to go back up as folks are getting more into the riskier junk bonds because they give a higher yield and they're willing to take on that risk. And then we look at another ratio of 3 to 7 year bonds to the S&P. When this is going down like it is now, that means bonds are underperforming stocks. We look at a correlation between stocks and bonds, and after being neutral for a while, we're actually starting to see them go in the same basic direction. We look at the S&P 500 with the 10-year yield showing how stocks are outperforming, even though they've been pulling back recently, going back to the earlier part of October. Junk bonds doing well, falling back a little bit here, but still above their 50-day moving average. And then we look at a ratio between junk bonds and more conservative bonds like government bonds. We were seeing a real shift in this ratio, but now it's starting to go back up, which is what we were seeing more over the last few years. And we look at the volatility of bonds on top, and that's been going up as bonds have been going down in price. We look at the volatility of stocks measured by the VIX. They've been going up lately. But when we look at the correlation between the two, they're pretty much neutral right now. A monthly chart of the long-term bond, it finally broke above its 50-day moving average, only to come back down and fall back below this long. It's not a 50-day moving average, it's a 12-month moving average here. So this is much longer term. And then we look at a ratio between the long-term bond and commodities, showing how bonds are still outperforming longer term. And we look at some different sectors. First, I break this down on, we look at the 11 different sectors, and I have some other areas to look at in this area, this section as well. But the materials, they've been doing really, really well. They're in an uptrend, but they've fallen back down to their 50-day moving average. This is more, if the economy's doing better, materials do better. If the economy's weak, materials are doing weak. But when we compare it to the S&P, it's still underperforming on a ratio basis. Communication, a stronger area, looking pretty solid right now, and kind of going sideways because communication has been doing well in 2024, but the S&P has been doing well, and that's why we're not really seeing a breakout here with this ratio. Energy, which has really been under a lot of pressure when you use the ratios, it's still in an uptrend when you take it by itself, but really underperforming when we compare it to the S&P 500. Financials coming off of recent all-time highs. The banks are holding up really well for right now and doing pretty good, even though we saw some profit taking later last week, but there's an uptrend with this overall ratio. Utilities, my goodness. Industrials doing really strong, seeing some recent profit taking. Industrials compared to the S&P in an uptrend, recent golden cross here, but pulling back this past week. The tech sector, this is really what drives the market higher or lower, still in an uptrend by itself. But in a downtrend, it's ever since we hit this really high reading back in the middle part of July, we've seen the tech sector really underperforming the S&P. Staple sector, toilet paper, toothpaste, doing really well when you look at it all by itself, but underperforming, even though we've seen a recent golden cross here when we look at this compared to the S&P. It was starting to go back up enough to generate a golden cross, but since that happened, this ratio has been really going down. Real estate saw some weakness recently with interest rates going back up. They're still above their 50-day moving average and looking okay here, enough to generate a golden cross when we compare real estate with the S&P. But as interest rates were going up, this ratio was going down. Utilities really solid right now, even though they've seen some profit taking lately. and doing really well when we compare it to the S&P. And this tends to be more of a defensive area for the market. Then we look at a ratio between the S&P and utilities. When this is going up, the S&P is outperforming. For the most part, this has been going down, which has been negative. That's why the S&P has been chopping a lot sideways on the daily charts. Healthcare dropping below its 50-day moving average and back to underperforming when we compare it to the S&P, a more defensive area. Discretionary doing quite well. Tesla came out with their earnings and just blew the market away, up 22% the day that they reported. And then we've been going up ever since then with Amazon, which is also in this sector, looking pretty solid. So even though we're in a downtrend here, we're showing some recent improvement. If this could continue, that would be more positive for the S&P. Semiconductors, a massive part of the tech sector, came all the way down to their 200-day moving average, and so far have been able to hang out above that. We look at another ratio between energy and tech, showing how energy is underperforming tech. We look at growth stocks versus bonds, showing how the growth stocks are outperforming, even though there was some weakness over the summer. The tech sector to the 10-year yield, showing how the tech sector has been outperforming, even though we're seeing some recent weakness. This is an inversion, showing how the 10-year yield has been underperforming, even though it's been seeing some strength as interest rates have been going back up. We look at a ratio between discretionary and staples. This is in an overall downtrend, but discretionary has really been doing well lately. If we can stay above both of these lines, we would generate a golden cross with this ratio. And then we look at an inverse, showing how staples lately have been underperforming, but they're still in an uptrend when we compare it to discretionary. We look at gold to the US dollar. Now, gold's been breaking out and setting highs. The dollar's been going back up, but gold's been going up even more, which is why we're seeing this ratio more or less going up. And we compare gold to the S&P 500. Gold recently has been outperforming here, but they pretty much have been going sideways as both gold and the S&P have been setting recent all-time highs. High leverage loans really looking solid right now, suggesting that according to this ETF, the economy is looking good going forward. The NYSE composite, which recently set an all-time high, did see some weakness, but still above its 50-day moving average. All stocks, which are U.S. stocks and international stocks, pulling back a bit, but still above the 50-day moving average. Emerging markets, a lot of interest in those areas. We've been seeing a little bit of favor as money's been going in here as they are in an uptrend. And the Japan Nikkei index, which is still a little bit below this 1989 all-time high, but not really falling apart. This big downward move, that was that big down day at the beginning of August. Micro caps, which are smaller companies, still in an uptrend as well. We look at the S&P and the home builders ETF on top. They're having a tendency to go in the same direction. Now, one might be going up, but that means the other one's going up, or both could be going down. Bitcoin is still in a downtrend, but it's been seeing some recent strength. We might see a golden cross here pretty soon. And then this is the KST, another longer term momentum oscillator, where China came out and announced a whole lot of things to help hopefully stimulate their economy. Well, now that kind of honeymoon is over and we've been falling back. We're also in an overall longer term downtrend in emerging markets, Europe and Japan, where we're actually trying to turn up here in the US. An intermarket analysis chart here with gold doing the best, followed by stocks, then oil, then the dollar, and bonds are negative year to date based on price. Then we look at some correlations. The S&P to the dollar, they had been going more or less in the same direction. Now we're seeing that working off a little bit right now. The correlation between the S&P 500 and oil are neutral. You can't get much more neutral than zero with this ratio. We look at the S&P to the 10-year yield, having a slight tendency to go in opposite directions, but coming out of giving a neutral reading. And then we look at the 10-year yield with tech also coming in and being more neutral right now. And then we also see the S&P 500 to the 2-year yield, after being neutral for quite a while, is now having a slight tendency to go in opposite directions. Then some long-term charts. Here's an NYSE monthly chart setting recent all-time highs above an advancing moving average. And the Copic curve, which is a momentum oscillator, continues to be positive. This is a daily chart of the NYSE where we're still going up with the NYSE record high percent index. So the chart's looking solid and this indicator is also looking pretty solid. And we look at a monthly chart of the S&P, we're above the moving average. So the S&P is looking well on a trend basis. We're also continuing to go up, rolling over possibly just a little bit with the percentage price oscillator, which we call the PPO. And we look at a daily chart here, the S&P above. Actually, this is a monthly chart above a 12-month moving average. And then we look at a ratio between stocks and commodities, showing how stocks are outperforming commodities longer term. Then we look at the S&P and then another global index showing how US stocks continue to outperform, but the KST is continuing to be flat. Then at the end, I go through all those things that are positive, and this is a pretty long list. The definition of positive is when the 50-day moving average is above the 200-day moving average. So we have growth and value by themselves. Copper is in an uptrend, the British pound, the euro, and the against the US dollar. Even though the British pound and the euro, as well as the Japanese yen, have been falling back, they haven't crossed over and made a death cross yet. The Japanese yen, even though it's been weaker lately, is still in an uptrend compared to the dollar. Gold, silver in uptrends, the big software companies, mega caps, the FANG index, low volatility ETF when you look at it by itself, but when you compare it to the S&P, it's really underperforming. Staples are in an uptrend, the Dow Jones Composite Average, all the different bonds that we look at based on price are still in uptrends, even though they've been weak lately. The tech sector, as well as semiconductors, high leverage loans, which I use that as kind of another barometer of the economy. The Dow, the NYSE Composite and Wilshire, which are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. Those are all still in uptrends. All stocks, both US and international, and then emerging markets are in an uptrend. Then we have a shorter list here, and this is when the 50-day moving average goes below the 200-day moving average. The CRB index, even though it's seen some recent strength, the dollar index, when you look at it by itself, it's really been going up, but it's going to take a while for those moving averages to cross over positive. ARK is in a downtrend, and Bitcoin could be getting ready to see a golden cross there, but it's still officially in a downtrend until proven otherwise. Thank you. I really hope you found this helpful. Have a great weekend, and I will talk to you in the next video.